he rents it to himself, to his practice. That's a very common thing you would see, having the real estate side on one LLC and the business in a different. Because the business, I understand, if it's making a lot of money, we talked about, I know in the podcast, about maybe electing to be an S corporation. Well, that would be something you would want to do for the business side. You would never do the real estate in anything that has the word corporation in it. So in that case, you want to have them separate. That gives you the opportunity to make that S election and be an S corporation to save some of the payroll taxes on your business as it grows. So yeah, having them separate is probably a good idea.
Yeah. Yeah. And one point he was making too was, what he tries to do is when you buy them separately, to heavily weight the acquisition cost to the business and to lighter weight, on the real estate, so that so that you can depreciate the equipment more, because the equipment depreciates quicker than commercial real estate, which we talked about, right? So there's a benefit there that depreciation number is going to be higher because you have less runway to actually depreciate it. And then, property taxes on the other side, which, kind of depends on where you're at in there. Now, however, the one thing to kind of consider with this is that if you're dealing with a savvy seller, the seller's not going to want to do that, right? And because the more that they sell the business for, there's going to be a higher, well, let me defer it to you. Why the seller?
Well, they want the building, obviously, sell the building, that they avoid any recaptures. Maybe the recapture, they lower the amount on the equipment, so they avoid recapture because they're doing an asset sale.
Yep.
They have, the benefits of maybe doing a 1031 exchange if they're selling the building and the land, that they could sell that abandoned building. You can still do 1031 exchange for real estate, so they may want to do that. So they want to include more money in the real estate side. So from a seller standpoint, that's where they want to put it. Now, again, from the buyer side, as you mentioned, Jordan, I want to put more of that against the equipment so I can get that depreciation, take that depreciation faster. This is all part of the negotiations, right? This is where you negotiate. Now, like I said, there is a special form that you have to file now with the IRS where both the buyer and seller agree that this is what we're putting into equipment, this is what we're putting into building and land or whatever. You're splitting it out, so we agree, because the old days, the IRS wasn't tracking that, so you'd have sellers treated differently than buyers. And now they've kind of nipped that in the bud a little bit, so you file that form to make sure that the buyer and the seller are treating that, how much is equipment, how much is building, and they're making sure that on the sale that they're treating it the same. So, but yeah, there is different motivations for the seller and the buyer in that case.